Welcome to section 5 of the Mama Never Told You Financial series. We're going to be talking about insurance in this section. I know it's not a topic that many people find super exciting. However, it is something that's often misunderstood, and I think it's really important to be an educated consumer when it comes to the insurance products that you're going to run across in your day to day lives. So we'll start with a quote. This is from Jesse Jackson. Many kids come out of college, they have a credit card and diploma. They don't know how to buy a house or a car or health insurance or life insurance. They do not know basic microeconomics. So that is part of what's driving me is the mission to change what's happening in his quote. So this is a disclaimer. I'm not an attorney. So therefore, if you need advice from an attorney, you should consult them. This is really just a guide to enhance your basic understanding of insurance. I am licensed, however, in the state of Ohio in health, life, and annuities, property and casualty, and title insurance. So I do have some background there and hope that I can add value in terms of the topics we're going to talk about. So we're going to go through some different types of insurance today. We're going to talk about homeowners and renter insurance, auto insurance, health, dental, and vision, which typically roll under an employee benefit plan offered by your employer in many cases. Life insurance, disability can also be under those plans, maybe separate plans as well. So we'll get into the weeds here in a minute. So let's dive in. So we're going to talk first and foremost about some important insurance terms under each of these policies before we look at some examples. So under homeowners insurance, you have your deductible, and you're going to find deductible is a common theme across all these insurance products. Basically, a deductible means before the insurance policy pays anything, what is your portion? So for a homeowner's policy, it may be $500, it may be $1,000. So basically, if you have an incident where we've had our basement flooded and we had an insurance claim, and maybe it was a $5,000 damage, or there was $5,000 of damage, we would pay the first 1,000, so insurance would only give us 4,000 in that scenario. So we'll talk a little bit more about what that means, look at some examples. Deductibles can vary quite a bit. Real property is really just the real estate with the property, so the house itself, garage, attached areas. Personal property is going to be the property within the real estate that's pretty much affixed or stays within the real estate. So your TVs, computers that stay, maybe a desktop computer, laptop, we'll talk a little bit about. Personal liability would be insurance that protects you in the event you were negligent. It can be for a number of reasons, but the most common, I guess, example cited might be something like a trampoline. So it can be on your home premises. Basically, somebody gets hurt, decides to sue you, and you have insurance protection for that. Floater and personal articles, kind of back to the laptop example, that is protection for items that may leave the house that are high value. So they're not in the property itself, but you do want insurance on them. Maybe a laptop's not on that list, depending on how much it's worth, but jewelry, if you have a wedding band or something like that that's worth thousands of dollars, you may want to protect it. So that's a pretty common item as well. And then renter's insurance is for those that are renting. And it really is just sort of a watered down policy combination of these. So it's going to have personal property protection and personal liability, but not real property. As you don't own the house, you don't really need to insure the house as a renter. So you're really just insuring your stuff and your personal protection. All right, so for auto insurance, we have a deductible we've already talked about. Collision coverage is going to protect you in the event that someone damages your vehicle through a collision. Comprehensive coverage is going to provide protection to your vehicle in the event that something else happens that damages your vehicle. Hail, a tree falls on it, God forbid, something like that. Liability insurance is, again, insurance to protect you in the event that you're liable. You cause an accident and someone's injured, so there's bodily damage. There's going to be a per person amount. There's a per accident amount, so that's usually a higher cap. And then there's property damage. So it's going to protect you for all of those items. And we'll show some examples here in a bit. Uninsured motorist coverage is coverage that protects you in the event you get in an accident and the person who hits you does not have insurance to pay for the damage. All right, health insurance. Again, there's that sneaky term, deductible. It's there always, right? Co-insurance is going to be the percentage that you pay of billables or billable amounts after your deductible. So the example I gave before on the homeowner side, let's just pretend you had a $5,000 surgery and your deductible is $1,000. Well, that means there's $4,000 left. On a typical health insurance policy, you will find that there may be a percentage that you owe of that $4,000. And we'll talk about that and have some examples later. Copay would be a fee that you pay when you go for a visit. Typically, that's associated with primary care, a specialist visit, maybe you go to an orthopedic, you have a knee injury, or if you go to an allergist, something like that. Urgent care and emergency rooms can have copays. So we'll look at some plans, varies by plan. Prescription copay, again, a copay that you pay for prescriptions. And then maximum out of pocket is what caps the maximum that you would pay out of your pocket, basically, for these plans. Premium is what you're going to pay monthly, typically, in terms of your insurance policy. So with an employer, what often happens, if you've watched our budgeting topic or if you looked at taxes, the employer is going to allow you to pay your portion out of your paycheck pre-tax. So it'll save you some tax money, but you're going to pay your premium typically out of your paycheck. So if that's biweekly, bi-monthly, whatever it might be. In-network is a service essentially that's provided by a doctor that has agreed to contract with your insurance carrier. So maybe they want to bill you $200, but your insurance carrier says, we're only going to allow $125. If that doctor has agreed to be in network, they're going to take the allowed amount. They have to by contract. So we'll show some examples of that as well. And then out of network would be a doctor that is not in your network, did not agree with your insurance carrier. They wanted that $200 and they're going to bill it. Your insurance is still going to pay based on what they call reasonable and customary. So they're going to look at doctors in the area and determine for the service you're getting, what is sort of reasonable and customary. What do 8 out of 10, 6 out of 10 doctors charge for that service? That is what they'll base their reimbursement off of. So we'll talk about that a little bit more with examples in a bit. All right, dental insurance terms, we've talked about deductible and copay. Preventive services are going to be just your teeth cleaning. You go in, you get your fluoride, they make you look squeaky clean and clean your teeth up. Basic services, typically I think of as getting a cavity and a filling. Major could be something like a root canal, something more serious. And then typically, contract maximums are going to be the maximum that any dental plan is going to pay out. So we'll talk about what that means as well. And then orthodontia is typically going to be carved out separately on a dental plan. It has its own coverage and then a max on what it's willing to pay. For your vision insurance, you're going to have an exam deductible and a materials deductible. So the actual eye exam, you would pay a portion, and then materials could be your contact lenses, could be your frames, could be any of the above. It could be the lenses themselves in terms of the eyeglasses. So you can see there's single vision, bifocal, and trifocal lenses. There's frames, and those are going to be obviously the frames of the glasses. The lenses are the lenses themselves. You can get contacts. And then one of the things that we'll look at is exam lens and frame frequency. So how often can you get those? What will the plan pay for it? All right, so now we're going to look at some life insurance terms. We're going to talk about term life first. So term life is going to be for a specific term. So basically, when you think about term life insurance, people are looking at a risk that they want to cover for a specific period of time. So if you have young kids and you're worried that if you pass, they may be in a tough situation, or you want to pay for college or pay off the house, maybe you insure for 20 years or 30 years until they're out of the house. So that's sort of the typical term policy. It's going to be the cheapest insurance that you can get. Whole life insurance is going to be a policy that, like it says, covers you for your entire life. So, another name for that is permanent life insurance. And what you're going to find is the premiums are going to be a little bit higher in the beginning. They're going to be fixed for the life of the policy, but they have to be higher to account for the longer time period of coverage. And over time, you're going to build what's called cash value, which is sort of at the bottom here. We'll talk a little bit about it. But basically, a portion of your premium, the amount that's overpaying the premium amount, builds a little bucket on the side with cash value. And we'll talk more about that here momentarily. Universal life insurance, very similar to whole life. However, the universal life insurance policy, that little bucket of money that you're building, you can actually grow it through some money market funds and very simple investments. In terms of savings, basically, very, very limited, very low risk type savings options. And as that cash value grows, there's a point in time where you can actually change your premium payment and reduce it using some of that cash value. So that's one of the benefits to universal life is you have a lot of flexibility. Variable life actually allows you to invest that money in the bucket, the cash value, in mutual funds and other investments that can actually grow a relatively competitive return. So that cash bucket could grow, it could also fall. And so that is the kind of big driver for variable life. Variable universal gives you the best of both worlds in the sense that you can invest that money, you can also use it for premium payments. And in all cases, you can actually take that cash value as it grows, borrow against it. And in many cases, most policies, I would say, you'll see here the death benefit. That's basically what's paid out upon death. it will be reduced by the cash value bucket. So we'll talk about some examples there, but let's just pretend I had $5,000 in my cash value. I had a $100,000 life insurance policy. If I pull that $5,000 out to use for whatever purpose, that $100,000 when I die is now reduced to $95,000. Typically, there are some policies that you pay a little bit more for that you can use the cash value without reducing the benefit upon death. So that's getting into the weeds a little bit, but that's sort of the big difference. And as I mentioned, death benefit is what you get, or what your family, I should say, or beneficiary would get when you pass. Surrender charge. So over a period of time, you have this cash value bucket building up. If you decide to cancel your policy, you're actually entitled to that cash value to take back on these variable and whole life policies. However, there is a surrender charge that, depending on when you cancel, so if it's in the early years, you might lose all of that value. If it's a little bit later and you've had the policy for quite a while, there may be a very minimal or even no surrender charge. So basically, that is just an offset against that little bucket of money that you've been growing that reduces what you get in the event that you do end up closing the policy. All right, important disability insurance terms. Short-term and long-term disability we'll talk about. They are like they say, I guess. Long-term is going to cover you in the event you're disabled or out of work for a long period of time. Short-term is going to do the same, but for a shorter time period. The benefit that gets paid out is essentially the earnings or the wage that the policy will pay for you. The benefit period is how long it's going to pay for. The elimination or waiting period is how long you have to wait to qualify to get payment. And then definition of disability we'll dive into a little bit, but essentially it's going to look at your scenario and your disability, and it's going to say, can you do your own occupation? If not, you're disabled. If you can do any occupation, which is the any occupation definition, then that means you are not disabled under that definition. However, if your policy has any occupation disability, then it's going to pay out if you can't perform any disability. So ultimately, you're going to want your own occupation coverage, because that is going to be more specific to what you do as opposed to any occupation. So that's the better option if you can get that as your definition.